Okay, welcome back, folks, to another edition of Beyond the Numbers. I am your host, Chris Thompson, and today, once again, we cover the spring budget 2023. As ever, I am joined by my esteemed colleague, Tom Biggs. Tom, how are you doing?
Yeah, good. Thanks, Chris. Yeah, all good. All good.
Excellent. So this was a budget where we wondered if the Chancellor, Jeremy Hunt, would have really much, if anything, to announce, given all the tax changes from the autumn statement, mainly tax going up, I might add. However, there was maybe a rabbit out of the hat in one case, and as with many a budget, there was a very interesting statement or proclamation. I'll start with the latter. So the Office for Budget Responsibility, known for their very accurate projections, or are they? They have said that by the end of the year, inflation will be below 3%, amazingly. Now, obviously, a week has passed, so the dust is settling, or is it? Because people are still talking about the budget quite a lot, I've noticed. But unfortunately for them, in the last sort of 24 hours, it's been recorded that inflation went up from 10.1% to 10.4% in February. So rather than a downward trend, we seem to be maybe going the other way. So that's interesting. I'll be curious to see by December if we're at that level, Tom.
Yeah.
But anyway, moving away from that, I mean, obviously that does have an impact on what the government can and can't do in terms of spending, the amount of tax take they'll get, the fact that some of their debt is inflation linked. So it's something definitely worth keeping an eye on that does impact on tax announcements going forward.
Yeah.
Moving on from there, Tom, what should we start with? Corporation tax, because there were rumors that maybe, the backbenchers weren't happy. He might reverse the increases to corporation tax. What have you got to say?
Yeah. So you're right. So there seemed to be quite a lot of pressure from within the Conservative Party themselves to reverse the increased corporation tax. Now that this was obviously announced quite a while back. We had attempts when Liz Truss had a short stint in office to try and reverse that. That didn't happen. So basically where we are is that is still going ahead from April this year. So the main rate of corporation tax is going to be 25%. If your profits are below 50,000, you'll stay at the 19%, and then we've got what's called effectively a marginal relief band between 50,000 and I forget the figure. It's either 250,000 or 300. So as an overview, obviously, corporation tax is going up now. As part of the announcements previously, and has been in place for the last couple of years, there is the super deduction for capital allowances, which has given companies a 130% write-off of qualifying capital expenditure.
Right.
Now, there's certain conditions where it has to be new expenditure, so on and so forth. New expenditure being brand new items, typically. Now, that's due to end at the end of this month. So, without any announcements, that was coming to a head, and we're back to the realms of just AIA covering off your expenditure for write-off, which at the moment is £1 million. Now, what was announced in the budget last week is that Jeremy Hunt wants to move towards what he's calling capital expensing, which basically means if the same expenditure that would qualified for super deduction previously, you're incurring after the super deduction finishes, you can write that off against your taxable profits in full, provided again it's brand new items, so on and so forth. So what he's done in essence with that is lifted the AIA cap for brand new qualifying items to kind of unlimited, really. So you can write off however much you like, provided the conditions are met.
They have to be new.
Has to be brand new items.
Straight out the packaging kind of thing.
Yeah. And it only applies to companies as well, as was the case of super deduction. So sole traders and partnerships, you won't benefit from that.
Just limited companies. Got it.
Just limited companies, yeah. Now, I guess the thing to think about from an SME perspective is that or very few, shall I say, companies exceed £1 million of expenditure in a year.
It's a lot of money, isn't it? Let's face it.
Yeah. So certainly for,
especially if you're small.
Yeah. So the sort of stereotypical OMB SME type companies, it's not really going to have much of an impact because you've got the AIA there anyway.
Right.
So whilst the sort of headlines look great in terms of, I think he quoted a £9 billion tax giveaway as part of the budget. That's all very well, but for a lot of SMEs, actually, it won't really make much of a difference because they had that anyway to an extent.
Presumably, there's also the cost of making sure you're compliant with the rules, submitting your claim, etc., dealing with HMRC potentially in such situations, etc., etc. So, nice headline figure, but there are costs involved with such matters anyway.
Yeah. Correct.
Good. And then moving on from their tax, from there, Tom, research and development.
Yeah. So again, there's been a lot of change around this. It was certainly announced within the autumn statement that there was going to be a lot of change around this from April. So as a recap from that, from April this year, the SME enhanced deduction for qualifying expenditure was reducing down to 86%. It's currently 130%. So quite a change there, and the repayable credit that an SME can claim is going down from 14.5% to 10%. Now, linked to that, if you like, the RDEC scheme, which is typically a large company scheme, if you like, the RDEC credit is increasing from April from 13% to 20%. So we've kind of got a takeaway from the SME scheme, if you like, and then a give back to the RDEC scheme. And broadly, it's the rationale is to try and balance up the schemes a little bit. So that was coming in anyway. As part of the budget last week, it was announced that actually, yes, that is coming in. However, for R&D intensive SME companies, there will actually be the ability to claim the old 14.5% repayable credit as opposed to the reduced 10% if you meet the conditions for being a R&D intensive company, and that is based on the current guidelines and what's been announced so far. That will be if at least 40% of your total expenditure is on R&D qualifying expenditure. So your total expenditure, if 40% of that qualifies for R&D, then potentially you're within the realms of being able to claim the 14.5% repayable credit if you're loss making.
Good, got it.
So slightly good news for the SME scheme, albeit that it's still nowhere near as generous as what it currently is.
And what they're sort of previously announced restrictions in relation to overseas workers, subcontractors, that kind of thing. Is that right?
Yeah, you're right. So there was going to be a restriction in terms of what overseas costs you could claim. Again, the sort of bigger picture is they want to try and focus the actual R&D activity to be within the UK. Now, as part of the budget, what was announced within the small print was that that restriction on being able to claim overseas subcontractors and externally provided workers is going to be pushed back a year. So rather than coming in April this year, that's been pushed back to April 24 as things stand.
Got it.
So again, slight relief for the SME scheme, certainly for companies who are reliant on overseas elements of their R&D projects.
Got it. Excellent. And just to go back to the corporation tax changes, Tom, just to clarify, I think the tapered rate is between 50 and 250,000.
Yeah.
And then the main rate is above
that,
250,000. That main rate
Correct.
is 25%. Yeah, just to clarify.
That's right. Yeah.
Excellent. Okay, so right, and that's interesting. What that then does is finally moves us on to what appeared to be his rabbit out of the hat. We heard that there may be changes to pensions in terms of the annual allowance going up, and we believed that the lifetime allowance would increase. But there was a little surprise there, Tom. Can you divulge a little more?
Yeah, so I'll touch on the savings allowance first, and we'll come on in a sec to lifetime bit. So, as it was announced just before the budget, there was an increase to the annual savings allowance. So at the moment, you can save £40,000 a year into your pension and obtain tax relief for it. Now, there are certain ways in which it's tapered, which we'll come on to that in a second. But as a sort of headline figure, you've got £40,000 a year to contribute. Now, that's been increased to 60,000 as of next year. So effectively, you've got an extra 20 grand that you can put into a pension and obtain tax relief on. Now, linked to that, there's also a mechanism whereby actually that headline figure gets tapered if your income's above a certain level. At the moment, that level's 240,000. That is increasing to 260,000. So yeah, again, a 20 grand increase in line with the allowance going up. Once you're above that, your annual allowance gets tapered by £1 for every £2 over you are. Previously, the minimum that you could get tapered down to is £4,000, and that's currently the case. That is going to increase to 10,000 again, right. Next year. So irrespective of your income, if you're above the 260,000 threshold, you can still contribute £10,000 in as a minimum. Now, again, headline wise, that looks great, but I guess from a practical perspective, to be able to contribute £60,000 into a pension and have that sort of disposable income, you're probably going to need quite a high income from that. And as I've just said, once you go above a certain level, you get tapered anyway. So I'm expecting that the number of people that can actually contribute a full 60,000 is probably not going to be that many.
Right, a limited few.
Yeah,
yes.
Yeah.
So if you've again, got that money to hand, it's quite unusual, really. Yeah.
Yeah. So again, headlines, and when it's when all the news outlets kind of announce it, all looks great, but in practical terms, when you look at the small print and how it actually works, it's probably not all the bells and whistles that perhaps it appears.
Yeah, sounds like that's the sort of it's been the long-term theme with pensions, is that actually there's a lot of rules and regs, and if your income's above a certain level, you've got to look at things carefully.
Yeah.
And it also sounds like that rabbit is kind of crawling back into the hat based on what you've just said.
A little bit. And there's, so we'll move on to lifetime allowance, which you've made reference to as well. So again, that was, as you said, the expectation was that was going to be increased. And well, I say a lot of it. Certainly, an element of these announcements of pensions revolves around the NHS and doctors and that kind of thing, because typically, that people have been discouraged to continue working and retire early because of the pensions tax charges that go with it. So it's been aimed at that, and part of that is that the lifetime allowance was expected to increase, as I've just said. Now, what was actually announced was that it's going to be abolished. Instead of just increased. So effectively, you can save as much as you like into your pension without the worry of that lifetime allowance cap, which at the moment is just over £1 million. But so they're going to do away with that. So again, looks great, and it's certainly welcomed in terms of administration and that kind of thing. Again, within the small print, the amount that you can take out tax-free from a pension, which is at the moment 25% of your pot, that amount, irrespective of your lifetime allowance going, is still going to be capped at £268,275. So yes, you can save more into your pension without the worry of the lifetime allowance, but the amount that you'll pay tax on will go up as well. So
if you breach that, what happens? You get taxed at your marginal rate, is that right?
Yeah, that's right. Yeah.
That's your highest rate of taxation, effectively.
Yeah. So
right.
Yes, you're at the moment it's tax efficient to pay into pension. Yeah, you get tax relief on it and so on and so forth. But with that cap being frozen in terms of what you can take out tax free, if you contribute more in, or effectively all you're doing is deferring when you're going to pay tax ultimately, because the 25% cap isn't going to increase above the current lifetime allowance.
Got it. So, okay, and unless you don't take it out, that stays in there, and presumably just getting a little off-piste of our agenda and thinking about what I've read of late. So you keep it in there, or you keep adding to your pension pot with the right estate planning, you can potentially pass that on free of inheritance tax, obviously depending on circumstances, things like that.
Yeah, you're right. It can be, Chris. Yeah, I mean, there's again, it's fairly techy, and there's certain conditions, so on and so forth, that have to be met in order to do so. But yeah, pensions can be quite an effective IHT planning tool.
So it's a potential option and something that people should probably look into and get in touch with good folks like yourself.
Indeed.
Good stuff. Anything more you want to add to any of that, Tom?
I mean, there's plenty we could talk about, Chris, to be fair, given the amount that comes out in the small print. There was, obviously there's changes to sort of the childcare regime, tax-free childcare, that kind of stuff. You probably haven't got time for it now as such, but again, one sort of common theme that we've had coming out of the last few budgets and autumn statements is that there's going to be more funding to HMRC for the collection of late paid tax, so on and so forth. So there's certainly, for the last few that we've done within the small print, there's been some sort of extra funding to HMRC to tackle perceived tax avoidance, late payment, that kind of thing. So what we're expecting is that HMRC will get a bit more aggressive in terms of chasing in tax from taxpayers who are paying late or have got outstanding debts. But also inquiries are probably going to go up moving forward as well, given the extra funding they've got. So, again, it's just something that people should be aware of.
And how might one protect oneself against such inquiries potentially?
Well, I mean, it's making sure your records are all in good order, needless to say, and should HMRC come knocking, you've got everything's ready to go. There are providers of sort of tax investigation insurances. Some places do a sort of tax investigation subscription to sort of cover off typically advisors' fees for dealing with it. So not any additional tax that comes out necessarily, more the assistance that people need for dealing with these inquiries, because again, it's quite a sort of specific method that you have to kind of go down for dealing with,
and very time consuming, back and forth with HMRC, inspectors coming in, that kind of thing potentially.
Exactly. Yeah.
So basically what happens is the accountant or tax advisor's fees are usually based on an hourly rate, for example. The longer something like that goes on, the greater the amount in terms of fees. The protection limits that to a degree, is what you're saying.
Yeah, exactly. Yeah.
Okay, I think what this highlights, that's really interesting. Clearly, there's what they could refer to as the tax gap, what HMRC are taking versus what they perceive they should be taking, and that's, I mean, I think we've blogged about that and talked about that for over a decade.
Yeah.
It's interesting that every budget there's something announced that keeps sort of increasing the power of HMRC going forward. And I think what this sort of pertains to, and it's been a theme, I think, again for the last decade, is that we now live in an era, whether you like it or not, of bigger government, and bigger government needs funding, and that funding comes through taxation. The tax take is, I believe, as high as it's ever been since the war. And I believe that in 24, 25, and certainly 25, 26, it's going to reach a new all-time high. So don't expect too many giveaways going forward, given that information. I think there may be the odd perceived rabbit out the hat, as we've just discussed, but when you look into the detail of it, probably not as generous as at first it may sound. Try and get my words out there. Tom, thank you very much, as ever, and definitely catch you for the next one, if not some more tax explanations going forward and analysis. Cheers, Tom.
Indeed, yeah. Thanks a lot, Chris.
And folks, be sure to subscribe up there.